Hey there, I welcome you again in this next chapter of our course on option trading strategies. So far, we have finished 5 chapters and we are almost at the midway of our course. Now, in this chapter and the next chapter, we will talk about those two strategies in which, even if you are a buyer or a seller, both have equal chances of making money. And this is actually one of the most talked about strategies in the world of options trading. I can even dare to say one of the most talked about strategies in the world of trading. I'm talking about the strategies of straddle and strangle. We'll talk about straddle in this chapter. In the next chapter, we'll talk about the strategy of strangle. Now, what is a straddle? A straddle is that option trading strategy in which a buyer of a straddle does not have a clear sense of direction but is expecting a huge movement on either side. What I mean by that is this: the market is right now trading at a very sensitive zone through which either the market can go up or can come down, and the move can be very substantial. The word substantial is very important because you would be taking the strategy only when you're expecting bigger moves in the market. Why so? Because you would be having two option position in your hand and you'll be paying a decent amount of premium. So to be able to make profit in the strategy, the market has to move substantially in one direction, and which is why the strategy is kind of talked among both buyers and sellers. Now, why do sellers also are interested in the strategy? Because at the time of writing of a strategy, if they feel the market will move but the move won't be exaggerated, then they can get a hefty premium because you would be getting premium from two legs. I'll talk about those two legs in the strategy, but you'll be getting premium from those two legs, so you want to pocket both. So which is why it has the interest of both buyers and seller. Before I talk about the strategy, there's one simple concept which needs to be clear, that is the concept of moneyness. In the money, at the money, and out of money. If you're not aware, just a small revision. So what are in the money contracts for call option? So for call option, in the money contracts are all those contracts which are below the current price of the underlying asset. Just for example, if the Nifty is right now trading at say 19,800, so all the strike prices below for call options like 19,750, 19,700, 650, 600 and so on the downside are in the money. And out of money strike prices for call option with those strike prices which are above the current spot price. So in case of 19,800, the strike prices of 19,850, 900, 950, 20,000 and so on, they'll be all out of money strike prices for call option. Now coming to the moneyness for put option. In case of a put option, all the strike prices which are above the spot price. Say the spot price is 19,800 and the strike price of 19,850, 900, 950, 20,000, they would be all in the money strike prices. And out of money strike prices for put option will be all the strike prices below, like 19,750, 700, 650, 600, so on, will become out of money. So whatever is in the money for call option becomes out of money for put option and vice versa. Now what is at the money? Because at the money is the most important concept when we are building the strategy of straddle. So the strike price which is closest to the spot price becomes at the money. Say for example, if the spot price of Nifty is 19,790, so what will be the closest strike price? That would be 19,800. So that becomes at the money strike price for both call option and put option. That is a simple explanation of moneyness of option for both call and put. Now coming to our strategy of straddle. How does one go about implementing this strategy? There are two legs involved into it. So if you are a buyer of a straddle, if you're someone who's willing to go long in straddle, so you buy at the money call option and at the money put option. So that is how you implement the strategy of long straddle. And if you're someone who's willing to short or sell the straddle, so what you do, you sell at the money call option and at the money put option. So that is how you implement the strategy of straddle. Now, what are the important technicalities? For starters, it will be slightly expensive to execute a straddle because you're going at the money. At the money options are slightly expensive, so you have to be expecting an exaggerated move. That is the most important premise when you're implementing the strategy of straddle. Now let us understand the implementation of the strategy of straddle via the payoff chart. Now if you were to focus on my screen, we'll go to a strategy builder and we are going to go for the straddle. So in case of, for right now, the spot price is 19,709 and I'm looking to show the example of Nifty. So you basically have to change this to options and you take this coming expiry, which is the 3rd of August. So what you do here is this: you simply choose the strike price of at the money, which would be 19,700 or as for in our case. So you buy 19,700 call option, you add that position, and also you buy 19,700 put option, you add that position also in the chart. Now as you can see, this is how a payoff chart looks like. So as you can see, there is a small zone of red within which the writer or seller of an option makes money, because he's not expecting exaggerated movement in the market. So what becomes a point at which the buyer of a straddle makes money? So you have to take the strike price and add the total option premium paid on the upside to get the upside strike price, and deduct that amount of premium from the strike price to get the downward break-even point. Now let us calculate that. Say the strike price which you chose was 19,700, and the total premium which we have paid is 169 units, 99.7 for call option and 69.3 for put option. So you take 19,700 and reduced 169, so you get 19,531, and if you add 169, you get 19,689. So only when the market goes beyond that range upon expiry is when the straddle buyer makes money. And for seller, this 300 points, 350 points become the zone within which he expects the market to stay. So whatever option is written, he can pocket certain amount of premium. He gets the full premium in his hand only if the market expires at 19,700. But even then, on the either side, he has a cushion of 170 points, because that's a premium which is received. Only if the market goes beyond those points, he will start losing real money in the market. And which is where these kind of strategies needs to be implemented with a lot of caution and care if you're looking to implement the strategy of straddle in the market. So that was it from in this chapter, where we understood the strategy of straddle. If you haven't yet understood, please go through this chapter, because this strategy is very important, because this strategy is one of the most talked about strategy in the world of option. In the next chapter, we'll talk about the strategy of strangle. So see you there.